So, if the Federal Reserve essentially creates money out of thin air, uh, why can't they just print enough to wipe out all the national debt tomorrow?
Right, the magic money tree question.
Exactly. I mean, today we are taking a deep dive into Chapter 15, looking at the hidden mechanics of money and financial institutions. Our mission here is to figure out exactly how the economic engine actually runs and, why simply printing more cash is a recipe for disaster.
Yeah, and to really understand the system, we first have to look at what money fundamentally is. Like, forget the standard textbook examples of trading chickens for wheat.
Because barter fails,
Right.
lacks liquidity.
Exactly. It's much more accurate to think of money as the ultimate economic API, like an application programming interface.
Oh, that's a good way to put it.
Yeah, it's a standardized protocol that allows two completely different operating systems, say, a freelance graphic designer and a corporate landlord, to seamlessly communicate and transfer value.
But for that API to actually function reliably for you, it has to have very specific characteristics. It has to be strictly scarce, highly durable, portable, and easily divisible. And if it meets those criteria, it serves as a medium of exchange, a standard of value, and a store of value.
Spot on. But we also have to remember the actual money supply is far broader than just the physical paper in your wallet. It includes demand deposits.
Which means the digital number sitting in your checking account.
Exactly. And because the vast majority of our money is just digital data, the supply has to be heavily regulated to maintain its purchasing power. That job falls on the mechanic of the U.S. economy, the Federal Reserve.
The central bank.
Right. Their primary objective is managing that money supply, and they largely do that through open market operations. So when the Fed decides to expand the money supply to, stimulate the economy, they buy government bonds from commercial banks.
And they don't just hand over pallets of physical cash to do this, right?
No, not at all. They literally just log into a computer system and credit those banks' reserve accounts with newly created funds. They just type money into existence.
Okay, wait, I have to push back on how direct that mechanism is, though.
Sure.
If typing money into a spreadsheet is that instantaneous, why isn't it an immediate one-to-one trigger for inflation? We saw near zero interest rates for a decade following the 2008 financial crisis, and the system didn't just immediately flood with hyperinflation. If the Fed's tool is that powerful, why didn't the engine overheat back then?
That is a great question. It's because creating the money is really only step one. For that newly created liquidity to spark real economic activity or inflation, it actually has to enter the broader economy.
Right, it has to move.
Exactly. The Fed can credit a commercial bank's reserve account, but if that bank decides to, tighten its lending standards and just sit on the cash instead of issuing mortgages or business loans, the velocity of money stalls.
So the Federal Reserve essentially controls the faucet, but commercial banks hold the hose.
That is a perfect way to summarize it.
Which naturally transitions us to the actual role of those banks. The sources categorize them into depository institutions, so your standard commercial banks or credit unions, and non-depository institutions.
Like pension funds and insurance companies.
Right, and both models basically exist to solve this massive logistical bottleneck. They take dormant capital from people who have excess savings and route it to people who need to borrow it.
Yes, and actually, the academic term for that vital underlying process is our word of the day, financial intermediation.
Financial intermediation.
Yeah. Banks act as the critical transmission mechanism between savers and borrowers. But that entire bridge is built on psychological trust.
Which is exactly why the Federal Deposit Insurance Corporation, or the FDIC, is so foundational to modern banking.
Oh, absolutely.
By insuring individual deposits up to $250,000, the FDIC basically neutralizes the fear of a bank run. When you know your capital is federally guaranteed, you don't panic withdraw at the first sign of economic trouble.
Right, and that protects the entire fractional reserve system from just collapsing.
But the architecture of that trust is shifting really rapidly right now. I mean, historically, you trusted a bank because it had massive marble columns in the center of town.
Yeah, you could see it.
Exactly. But now, traditional financial intermediation faces an existential threat from fintech. The sources highlight Bank of America as a prime business example of this.
They do, yeah.
They are aggressively closing physical branches while pouring massive resources into mobile banking and AI-driven digital assistance.
Because that digital shift is forcing legacy banks to rethink their entire infrastructure. I mean, algorithms are replacing human loan officers, and peer-to-peer payment platforms are letting consumers bypass traditional banking fees altogether.
Wow.
The financial institutions that survive the next decade will be the ones that leverage customer data and digital convenience rather than just relying on geographic branch dominance.
So understanding these mechanics helps you recognize that while money simplifies your daily exchanges, it's really the Fed's monetary policy, combined with the lending decisions of these digital-first banks, that dictates your ability to borrow, save, and build wealth.
Absolutely. And as that landscape becomes entirely data-driven, the physical nature of our economy is just fading away.
Yeah, consider this crazy detail from the source material. A physical $1 bill wears out from handling in just 5.8 years.
That's so fast.
Right. So with fintech platforms and mobile apps actively dismantling traditional banking as we know it, how long will it be before the physical currency in your wallet is entirely replaced by a digital ledger, rendering paper money completely obsolete? Fascinating for you to think about.